Now, in the recent weeks, Kenya has seen a staggering fall of the shilling, protests over finance bills, and widespread discontent about raised taxes among citizens. We're joined by Ronny Chokaa, the research analyst at Genghis Capital Investment Bank, to talk to us about what the future holds. Thank you for joining us, Ronny.
Thank you so much.
Now, I went through the report, and of course, projections by the IMF and World Bank for different categories of economies across the board. You do see still a dip in GDPs coming for the rest of the year. Now, how does that correspond to suggestions being made about stagflation and the combination of this recession with inflation and the fact that it is here to stay as per your report? How do you think is Kenya going to manage this? What is going to be the scenario to begin with?
Thank you so much for welcoming me to your show. It is right, as you point out, that the global shocks currently have compounded to place the global economy at a slowdown, to which Kenya has not been an exception. The three shocks of rising inflation, rising interest rates, and waning business and consumer confidence have really dampened growth prospects going forward. And what makes this slowdown more nuanced is that if you look at our quarterly report, we actually point out that a prolonged slowdown equals a recession. And what makes it all the more nuanced, in our view, is that this recession comes amid elevated inflationary pressure. And when we funnel it down to Kenya, you notice that we're already witnessing the effects spilling over into our Q1 numbers, with the Q1 growth coming in at 5.3, slowing down from 6.2% in Q1 2022.
Right. But looking at how this is not just the case of Kenya and how different economies are so connected with each other, how is this inflation? Is there any chance that other nations might hike up their own MPC rate? And if that is something that Kenya might see further increment in that?
Thank you. We're looking at a prolonged slowdown from how we're looking at it currently, because we've not seen a decline in production yet. What we are noticing only is that there's waning consumer confidence. That is to say that consumers are less willing to spend. And we're also witnessing corporates report declined earnings as a result.
Right.
So in terms of its implications going forward, we think that if and at all this slowdown is prolonged, in light of also the current inflationary pressure being witnessed, it's likely to push down growth prospects even further. If I take the case of Kenya more specifically, you notice in over the first quarter of this year, Kenya reported a decline on the agricultural sector, a contraction actually, while even the manufacturing sector reported a decline in terms of its contribution to overall GDP. While other sectors like hospitality sector are reporting improved prospects, predominantly due to a robust post-COVID recovery. This recovery has not been so strong enough to the pre-pandemic levels. And as such, I think this is what informs our forecast of a decline in growth to 4.2% in this current year, down from 4.8% recorded in 2022. And we attribute this to three factors. Firstly, being waning business and consumer spending, because we know that consumer spending is the cornerstone of economic growth. We are also looking at rising interest rates and how what it implies for investment spending. We know there's an inverse relationship between rising real interest rates and investment spending in the economy. And from where we sit, if you look at the real rates, that is the Fisher effect adjusted for inflation, you notice real rates have been rising, and this implies that the economy's effective investment multiplier is set to decline. And thirdly, which is also what we pointed out in our quarterly outlook, is that this policy mix adopted by the government is not particularly as favorable to growth. When you look at the fiscal policy, the government is more active now on fiscal consolidation. They are keen on trimming down spending and also mobilizing revenue. Effectively, they aim to condense the budget deficit to 4.4% of GDP, down from 5.7%. And if you look at the rising interest rate environment on the monetary front, effectively, we're having a double contraction. So reduced government spending coupled with rising interest rates are set to effectively pull down growth prospects. And even given that Kenya is structurally an open economy, and in light of the weakening shilling, you notice that the cost of imports have been soaring exponentially. Case in point being critical imports such as fuel and food. And when you have such critical imports having a surge in prices, it only widens your current account deficit. So effectively, the gross real GDP growth, in our view, is set to slow down to 4.2%.
But, you know, at the same time, I completely agree with what you're saying, but at the same time, you're also seeing certain markets performing slightly better. So looking at this different sectoral performance, is there something to gain from in this situation for the central banks, a move that could work in the favor of Kenya, before we let you go?
The good thing, actually, when you look at price levels, is that you notice that inflation softened in July on account of lower food prices. We also realized that due to the improved weather conditions, we are witnessing improved harvests, and as such, this is likely to beef up food supply over the medium term. Now, the shock that which we believe central bank is not really prepared for is the soaring fuel inflation. Given that majority or the larger share of our fuel needs are imported, we are susceptible as an economy to price increases of this commodity. And what you also notice is that as a result of this fuel inflation, it gives core inflation a persistent quality.
Absolutely.
In other words, core inflation remains sticky downwards. And now,
Ronny,
given that
you're absolutely right, but we're going to run out of time now. We actually have run out of time, but thank you for your insights. And of course, fuel inflation has been a big concern in Kenya. We'll have you over again for more.